Hello everyone, my name is Uwais Asmal and I'm the Head of Advisory Services at Outsourced CFO. One of the most valuable services that we provide to our clients is called the financial gap analysis. We've prepared many of these financial gap analysis reports over the years for many clients. And what we've come to realize is that many of the same issues keep popping up. So what I wanted to do was prepare a series of videos for you where I could share with you these most common risks that keep coming up, and you can have a look and see if you can fix that in your business. One of the most important things that come up is not having a clear strategy. The old adage of failing to plan is planning to fail. Business owners don't know how long are they holding their business for. Are they planning to hold it for the rest of their lives? Do they want to sell it in 5 years? They don't know what their strategy is, because depending on that strategy, you would make different decisions when it comes to your expenditure. For example, if you plan to sell your business in 5 years, you want to make sure that your profits increase over the year. So you would manage your expenses a lot tighter in terms of maybe not spending as much on marketing or reducing a certain number of expenses before year end, so that you could get your increase in profitability so that you could sell your business for the highest value. Not planning can result in certain things like having an incorrect pricing structure, maybe overpricing or underpricing. And these things can result in your company going out of business. Another big issue that keeps coming up is financial statements. The financial statements are not audited or reviewed. The Companies Act has specific requirements for different levels of companies. Either your company needs to be audited, independently reviewed, or just a compilation that needs to be prepared. Depending on the size of company and the number of employees and the debt levels and one or two other requirements, you fall into one of these three categories. Are you aware of which category you fall into? Are your preparers discussing that with you? Because potentially you could be just having a compiled financial statements where actually the Companies Act requires you to have an independently reviewed one, which means that your financial statements are not compliant with the Companies Act. Or alternatively, you could be paying for an audit when your company just requires an independent review of your financial statements. What that means is you are overpaying, so you're wasting your money. Another issue that comes up is late financial statements or financial statements just not being prepared. The Companies Act deadline is 6 months after your financial year end. You need to have financial statements. Yes, income statement deadline is 12 months, but you need to comply with the Companies Act first. Another issue that comes up is having personal expenses going through your company financial statements, motor vehicle expenses, a couple of those other things. Yes, you know they do come up. You can think of a few right now. Or capitalizing expenses that shouldn't be capitalized. Or the financial statements are just not compliant with the legislation because they're not complying with a reporting framework like International Financial Reporting Standards or IFRS for SMEs. If you don't know what I'm talking about, you need to talk to your accountant. Another issue that also comes up is financial statements not agreeing to the management accounts. That's a massive issue because you are taking decisions on your management accounts and the numbers in your management accounts are incorrect. That could result in incorrect decision making. And the third item that I want to talk about is budgets and cash flows. It amazes me that some companies don't prepare income statement budgets or cash flows. Some companies just manage their business based on the money in their bank account. They don't consider the fact that they need to pay VAT in 2 months or in a month, or they need to pay provisional tax in 3 months. The only way you can prepare for that is by preparing a cash flow forecast. The minimum you'd need is a 12-month income statement budget, and based on that income statement budget, you can prepare a cash flow forecast. It's ideal that you prepare maybe update your cash flow forecast every 3 months, but at the minimum a 1-year budget and a maybe 6-month cash flow forecast. That's that for now. Feel free to tune into the next episode where we talk about the next risks. Thank you very much.
Hey, Lo here, one of the founders of Outsourced CFO. If you enjoyed this video, make it official. Click subscribe.